We're going to start today with looking at our calendar of events. You can see we're going into December. We're actually um, expecting a pretty decent month for December, as seasonality since 1980 has been very good for December and November. So for seasonality, we expect some good times. We have two major holidays. We have Christmas and we have New Year's. So both of those combine, we think, and end of quarter window dressing, end of year window dressing, that usually signals a good last couple weeks of the year. But we are currently overbought in a major way. We've been overbought for quite a while since the election. And as whenever you're investing, you have to think contrary to popular what's going on in the stock market. I buy this in 10-year terms, not just a momentum. In general, a momentum in the stock market that basically is what's been going on for a maximum 80. Don't be surprised. All stocks this trend line and zigzag up picture. Now, let's go back to, yeah, hold on for a second. Right. So now let's look at, we have in December, we also have a Fed meeting coming up next week. That'll give us a little hint um, about what the interest rates will be for the next month to couple months. And most expectations are we're going to reduce the interest rates for at least 1 or 2 more months. So let's look at some of the talking points here. We have um, the S&P, we're 50% above the 50-day moving average. We were 70%, um, and we're 69% above the 200-day moving average. So that's it was 76% last week. So we're losing a little bit of momentum. Um, and that's not a big deal. And the big picture, the big most important thing that's happening in the stock market, in the market in general, is the US Treasuries are going down. And we went down 1% in the 10-year this month. But as you can see in the chart for the 10-year Treasury, we went down for the past at least 2 weeks. And our general formula that we're going to stick to, regardless if it works all the time or not, is if the US Treasury yield goes up, the stock market will go down, and vice versa. If the yield goes down, then the stock market most likely will go up. So let's look at some more of the talking points we have here. Okay, we're in the December. So what I did is I included in this talk um, a little bit of guessing at what's going to happen next year. So we have, let me see, also the stock market first. I'm down 1%. That's not the price of oil goes up. And if the price of oil goes down, we have a lack of demand because oil is the making products. And and that could really have a big effect on inflation also. So we want the price of oil to be down. So inflation hasn't changed since last week. We're still at about 2.6%. The US dollar is uptrending, but it hasn't gone up a whole lot since last week. And the price of gold is down a little bit. So let me see. You can see the price, the US dollar index is continuing to rise. And that's primarily because of the Fed is reducing the interest rates. We continue to have a strong economy. So this is going to it's going to affect a lot of things like commodity pricing, and it's going to affect um, the profitability of the multinationals. As this dollar index goes up, the profitability of companies that do a lot of business overseas goes down. So we'll keep our eyes on that. Okay. Fear and greed index. This basically is a signal of how bullish or bearish, excited or fearful the average investor is. And right now we're at an all-time we're at actually neutral right now. We were greedy for the past couple weeks, and now the average investor is becoming neutral, and they're not buying protection for their positions. They're not afraid of a stock market going down in general. Um, but we're really frothy and we're really overextended. So I guess there's some well, we have a neutral stance. So neutral is there's really no action to take. Warren Buffett likes to buy when there's extreme fear in the market. We haven't seen extreme fear for a long time. So right now, there's a lot of indications that the stock market will continue to go up to the end of the year. Okay, and the last week we had a little break. We had a more bearish than bullish by a small little amount, but we reverted back to more bullish than bearish for the AAII, American Association of Individual Investors survey. So that's a contrary indicator. Whenever the average investor is loading up on stocks, that's the time you want to sell your positions to them. That's called feeding the ducks. Now, let's look at um, let's look at the VIX. The VIX is basically at a multi-year low. It's at 12 right now. So there's basically no fear in the stock market. There's not a whole lot of protection. Um, a lot of investors aren't interested in buying protection for their positions. So there's no fear right now, according to the VIX. And okay, so let's look at some more talking points. Okay, so because we're neutral in the stock market in the fear greed index, um, and the investing public is a little bit greedy. So I would say we've reached our new paradigm, which is AI, and we're kind of pulling back. We're going to pull back in a kind of consolidation phase and then at the end of the year we're going to go up. So right now we're kind of in denial. Can this AI tech um, tech rally continue? I don't know. Um, so whenever the investing public is fearful and there's capitulation and there's despair, this is exactly when Warren Buffett wants to buy. Warren Buffett is actually selling his positions when everyone's excited now. He has 354 billion in cash, and he's doing the opposite of what a momentum buyer would do in a situation. So we have some good news in some of these things I was worried about for that may lead to a crash. Um, we have a Elon Musk leading a Department of Government Efficiency that could really help the debt of the United States. And if we cut enough unneeded expenses, then the U.S. debt might somehow go under control. And that is a really good sign because the America is in an unsustainable path with their debt. Okay, so and we have okay, the other things we have to worry about is actually visiting with foreign leaders already, tariffs and a bunch of other things. So we're going to worry every day about random our positions lead to a crash. If let's say Trump says do something, that could definitely affect the stock market. Some more of our talking points. It seems like year are actually turning out to be the three best sectors from this year too. Look at this. 38%, 39%, 33%. And financials, which did subpar last year, 9.3%, we're at 34% this year, which is pretty good. And we have XLU, um, which utilities sector, they are they are doing pretty good, 25% versus negative 8.5%. I'm very surprised that the healthcare sector is only up 5% this year. That could be because um, RFK could be confirmed as leading the health for the United States, but that might not happen. So what we're going to do is by the end of the year, we're going to pick our first to worst for next year. And we're going to use some of our formulas to figure out which sectors will do the best. And okay, we already have. Okay, so this is a very interesting. Um, it's called an asset quilt for total returns. So what we have here is every year this lists the total returns in different sectors every year. And last year we noticed that utilities were one of the worst. Well, this is actually major sectors. This is for S&P. We have the global high yield. We have gold, different sectors like that. So you can see that they perform differently every year. And as an asset, whenever you give your money to an asset manager, they typically allocate in the different sectors. And these are more global um, major sectors that are not the United States stocks or bonds. These are more global allocations for your money. The interesting thing about this quilt is global returns have been subpar for like 20 years. It's been a very poor investment. No, it's been a very poor investment. If you invested into global stocks or global um, bonds, they haven't performed very well, as you can see um, in these charts. So basically, I guess if you can look at all these over time, the um, the foreign investments aren't that consistent. And what's happening right now is the United States is basically taking a lot of the money from around the world for the investments. We're going to talk about that later on. And it's been outperforming for multiple years, 10, 20 years. And it could be a bubble. I don't know, but we'll talk about it later. Um, but for me, I don't want to be investing into global high yield or global stocks or bonds because it's something I don't understand. Um, the purpose of diversification isn't to isn't to choose sectors that are going to underperform so you have an even portfolio. My goal is to make constant improvements in the portfolio so that I return like at least 11% in my growth stocks. And it's really hard to do that um, when you have uncertainty from uh, other countries in their exchange rates, in their policies, and things like that. So, um, okay, so we're gonna go over the asset quilt for United States returns before the end of the year, and we're gonna try to put together a portfolio of different sectors for at least the United States. We'll do that before the end of the year. Let's look at some of the best performing and worst performing um, stocks in the stock market. We can see Lululemon they had a good earnings report, and they went down 75% from their highs. So this could be um, a way for them to get a little bit of that 75% back. Um, you can see that the top 10 have a lot of server makers for AI. We have HP Enterprise. They do servers for data centers. We have Supermicro. They also do data center um, AI server development. We have Palantir, that AI company that's they actually implement AI in companies. And we have Broadcom. They make AI chips. Tesla, of course, um, is famous for doing robotaxis and things like that using AI. So we have um, so we have a lot, and monolithic power systems. They do AI data center build out. So the AI continues to be a top 10 performer. The top decliners, United Health Group. We have a lot of energy companies in this, and we have Most of these are energy companies. So if we look at the, let's look at the pre, if we look at the price of oil, the price of oil is remaining, um, is very soft. It's not performing very well. It's remaining around $67 a barrel. So that's going to make the energy sector less profitable. Let's look at some other sectors that are going down today. We have energy. Okay, well, as the price of oil goes, so does the energy sector. So energy select. Okay, so utilities are doing bad today too. Let's look at the 10-year. The 10-year has been in a downtrend for at least a month now. So you can see that 10-year, as the 10-year goes down, we expect the S&P to go up. So you can see that's true. There's an inverse correlation. Um, so we expect, let's look at our cheat sheet. Our cheat sheet is as the yield goes down, as you can see, the yield is going down. We have, we expect small caps to do well, highly indebted companies, um, utilities, healthcare, stocks that are paying high dividends will be doing better. Home builders, let's see if that happened today. Okay, sectors, healthcare, the ones doing the best, consumer discretionary, spiders retail, and okay, so telecom pays a high dividend. That makes sense. We expected biotech. Okay, they borrow a lot of money because they're smaller companies that aren't very profitable. So that makes sense that they're up today too. So technology, banking. Okay, so let me see. Negative for banks. Okay, so if the yields are going down, that should be negative for banks. So that didn't work out for banks this time. Okay, so all right, that was a good excursion. Okay, let's look at the next topic. Okay, so let's look at Dan Now's picks from the beginning of the year. He had Amazon and Meta as number one and two picks for his. Okay, so Amazon's up 49% this year. It recently rallied a lot. Meta's up 76%. Um, so Texas Instrument is only up 16%. XBI, the small cap biotech ETF, is only at 15%, and KWeb is only at 14%. So both KWeb and XBI, Dan mentioned that they were outperforming for 2 years prior to this year. So they were due for going up, but basically they didn't go up more than the stock market did. So these three positions here were actually not very good. But Meta and Amazon were um, hit the ball out of the park with those. All right. So the great thing about Meta is that Meta continues to innovate. They are using AI for improving their advertising on their platforms, and they are making sunglasses that are allowing you to take pictures and interact with your environment. So they're continuing to innovate and to make new products. So that's one thing I really like about Meta. And they continue to consistently grow around 20% a year. And Amazon, the great things about Amazon is they're actually starting to be very successful of making their own AI chips. They have a chip called I forget what it's called, but they're actually training AI models for Apple on it now, Trillium, and they might be re-rating as an AI provider. something like NVIDIA if they continue to grow like that. So we'll watch that and see if Dan actually continues to own these for next year. Okay, let's look at some charts of interest. Google's been out of favor recently. You can see that it's oversold at a stochastics around 20, and it's near the bottom of its trajectory. It's I included a guy who really advocates and buys Google aggressively, and he mentioned in a video this week that he continues to buy Google because he thinks Google is has a PE of 13 for its advertising business. And they have a lot of startup companies within that they're funding, such as Waymo, which are pretty valuable. And once, if he says he's not worried about the current antitrust issues for the company, and that it's a pretty solid company to hold for 10 years. So when a very smart guy like that talks about Google, and we'll go over that a little bit later, um, that gives me a little more confidence to hold the stock because I've owned it since 2008. So it's been my best performing stock. Um, and here's another stock, Meta. You can see that let me see, it's a near oversold position going up. So it's at 40, and you can see it's near a bottom. It's hugging the 50-day moving average, and it's above the 250 and 200-day moving average. So these are all signs of momentum that a stock continues to go up, and we're towards the end of the year also. So these are all kind of things that add up that tell you it's probably going up. So so if we're gonna review this on a regular basis, the sectors of the stock market in a Trump presidency, and how the Trump presidency could affect these sectors. Deregulation is the most important theme that Trump will have in what he does for in the first couple days. The interesting thing, we'll talk a little bit more about how uncertainty is going to be on everyone's minds as an investor, at least for the next 4 years, because Trump will basically he will do things randomly, sending text messages out that will affect the price of stocks every day. Um, so we have to we're the financial, consumer discretionary, and energy sectors have done the best since Trump was named the president-elect. And the worst ones are the healthcare, consumer staples, and real estate. So we have to really consider, all of this when we're looking at next year's um, allocations. And because the end of the year, between now and January 1st, as investors, you got to like be willing to reposition your portfolio for what could happen next year. And a lot of times that involves taking some losses this month and taking some gains. And a lot of times, if you have a lot of gains, then you want to counter those gains with some losses so that you don't pay a whole lot of capital gains taxes. So, okay, so what we'll do next, we'll go over. Um, this is a YouTube video. You should watch it. The link is right here. The YouTube video is about how this Bill Nygren, he's created a brand new large cap ETF. So the interesting thing about making a brand new ETF is you can look immediately at his top holdings. A lot of times, whenever you have a mutual fund, you're kind of stuck with some positions that may have not panned out. And you're stuck with you're still holding some stocks that might not be your top picks of today because you don't want to sell in because as a mutual fund manager, you don't want to sell a whole lot because that affects your customers. Because customers have to pay capital gains. But what we're doing today is we're going to look at what his new ETF it contains. He just started in couple like a week ago. So this new large cap ETF focuses on low PE multiples. He likes his average PE for his holdings is 13. The average PE for the stock market is 23 to 25. So that's half that of the stock market. He also focuses on having companies that give back to the shareholder, capital coming back to shareholders. And he also, he doesn't like some of the high-flying companies such as Nvidia and Apple and stocks that have been bid up recently with AI in mind. He likes companies that perhaps use AI because basically the companies like Cisco that enabled the internet in this 2000, they weren't the true winners. The true winners were the companies that actually used the internet, such as Google and Microsoft, etc., that they were the actual true winners in Amazon. So he thinks Alphabet is a bargain. He says the venture capital projects within the company aren't even priced in. So he thinks you're only paying 13 times for the search earnings. Um, and there's a lot of cash at Google too. So if you take out the cash, the price to earnings ratio goes down. So, so let's look at some of the top holdings of Oakmark Large Cap ETF. It's OAKM is the symbol, and you can see there's a lot of banks in here. And this guy he loves banks, and banks aren't traditionally a large. They're not a growth. Um, they don't grow a whole lot usually, maybe 5 to 7% a year. So they're not, and they pay a dividend. So this guy is always loved. Whenever you look at this large cap holdings, you have to realize he's always loved banks. And if you look back at his this year, his fund only returned like 16% because he's basically heavy on stocks that aren't high growth. And and his so his portfolio um you have to realize he's looking 5 to 10 years down the line when he buys his stocks. And and he focuses on low PE ratios, but he let's look at some of his holdings. Let's say his Schwab is the bank. We have AIG, they're kind of insurance company, financial company, and they have Wells Fargo, of course, their bank, and ICE, they of course do financial trading. So there's a lot of financials in this top 10. So, and this is interesting. It's a very old school Deere. They make tractors. So why would he choose Deere? And why would he choose all these banks? Well, it could be they're out of favor and he sees a steady demand for banking services in the future. So Warren Buffett also has very similar holdings of banks in his portfolios. So that might be something to that. Um, what I thought it would be interesting to do is to look at the ICE because we haven't looked at it in a while. They're, of course, the owner of New York Stock Exchange, and they do a lot of, um, well, of course, well, we'll go over ICE in the next little section here. But before we do that, I'm going to look at the Oakmark Investor, OAK. This is a mutual fund, and this has been around for a long time. Um, So let's look at this and compare it against the new ETF. We can see Alphabet is the top holding. He absolutely loves Alphabet, um, and he thinks that they're undervalued. Fiserv, they're a company that allows small businesses to take money in using Visa, MasterCard, etc. And let me see, we've been following Fiserv for quite a while in our charting. Deere and Company, of course, that was in their ETF. We see Citigroup, Schwab. Um, so basically, he he's making an ETF using very similar holdings as his mutual fund. Okay, let's go over ICE because it seems like it's in both his mutual fund and his ETF. And okay, ICE, of course, they're an exchange. They allow for trading, and you can see that they're only growing around 11% a year. That's not that great. I guess Bill Nygren likes the idea of, a lower PE ratio, but ICE has a PE of 23 and they're growing at 11%. So that means they're like two times overvalued. I don't know if I'd be interested in this stock right now. Maybe if it's in half, I'll look at it, but they're actually starting they're talking about coming out with the 24/7 trading. There's a brand new exchange that just came out recently, and the new competition um, is going to allow 24-hour trading. So, of course, ICE is going to do that also. Um, Let me see. So they have a kind of a monopoly in IPOs. Not a monopoly, but the Nasdaq does a certain amount of lower quality IPOs, but the most most of the newest and greatest, largest IPOs for the past 10 years have been on the New York Stock Exchange because there's more prestige. They have CNBC I mean, they have CNBC at the exchange doing advertising for their company every day. So CNBC says, well, we have a new IPO coming out. It gives all kind of buzz. That free advertising is one of the reasons why companies IPO there. There's prestige and there's immediate coverage and buzz whenever they're IPOing there. So, so they have this, um, they have a pretty good amount of the new IPOs going on their exchange. So they also have, they started a crypto exchange, and they partially own that, and there's recent talk about it being bought out. So that's a good catalyst. And they also have 24/7 trading coming very soon. So if you add all these things, they'll probably make more money if you have exchange open 24/7. Um, but right now it's pretty overvalued. And you can see that they're missing their earnings maybe once or twice a year by maybe 1 penny. That's not that much, but it's not very consistent that they can't make their earnings regularly. So I wouldn't be interested in this right now, but um, um, I think whenever Bill Nygren put together his portfolio, he's thinking 10 years from now that, they're going to remain, the dominant exchange um, in at least the USA. So let me see. And you can see that Schwab he's been holding this for like 10 years. He totally believes in that company. We talked about Schwab back when it was $50 a share. It's at 70 now. So that's a huge move. But Bill Nygren thinks in 10 years, there's going to be steady demand for trading and for banking services. And that's why he continues to invest in that group. So let me see. Okay, let's look at the statistics for ICE. You can see their um, PE ratio is 23. The market cap is only 89, so it's a smaller company. Their PEG ratio is 2 point. This kind of matches what we were looking at, 2.47. So Yahoo thinks that it's 2.5 times overvalued. So if you divide the price of the stock by 2.5, you'll get the real value. So profit margin is 25. That's awesome. That's double what we want. Return on equity is 9. That is barely what we are, our minimum. So they have 21 billion, it's like 21 billion in debt minus 1 billion in cash. That means 21 billion out of 89 billion is still a lot of debt. So when they bought the New York Stock Exchange, they took on a lot of debt, and that limits the growth of the company whenever you have to continuously um, pay down uh, what you owe on the debt on that debt. So one thing that if I was looking at this company to buy, I would seriously watch this every quarter and make sure that they're somehow paying that off. Because if that grows, that would be a headwind for the company. And as interest rates go up, that's going to be cost more to finance. All right, so that was a good little excursion. Okay, I do this every week. Um we have a screen that we do. Um and the screen I like to review the screen that we do every week. Hold on, it's worth it. Okay, the screen we do is this. We have return on equity greater than or equal to 12. We have profit margin greater than or equal to 12. Market cap over 50 billion because larger companies, they're a little bit more reliable. Forward PE, we want it to be low compared to the growth rate. Growth rate, we like to have greater than or equal to 10. And PEG ratio, we would like to have it less than or equal to 1. And quality companies usually sell for higher PEG ratio. So you pay more for a car that starts in the morning. So if you buy a quality company that's growing consistently, you'll have to pay a little bit more for the PEG ratio. So given all that, let's look at our screen for this week, see if there's any changes. Okay. Um, we have our familiar top 10. Not a whole lot has changed. None of these are actually new for from last week. So a lot of times stocks drop and you have to consider, that. Um, we look at Uber. What's interesting, you can see that its PEG ratio is zero point 0.7. We went over this a couple weeks ago, and Uber seems like a great company. There was a news story this week about Google and how Google is expanding their Waymo service into Miami. And so this stock dropped as soon as that came out. And that is um and also what happened this week, Elon Musk posted something that says he expects 25 million robo-taxis to be soon on the road. So you have not only Tesla promising millions of robo-taxis working 24/7, you also have Google entering new markets like Miami. Um, so Uber is very well, they have an outdated business model. They have people driving their car, and they also are working with Waymo a little bit. So they're not going to be, they have a lot of um, potential disruptions that could disrupt their profitability. So I'm not at this point in time considering Uber because their app is the only thing they have going for them right now, and that you have a customer base that are used to using their services. That might go away if Google charges half, for the ride and it's reliable. So let's look at some of these other ones. App Lovin is one of the most is the best performing stock, I think, since the beginning of the year. And you can see its peg ratio, even after going up like hundreds of percent this year, its peg ratio is maybe 10% overvalued. So they're a company that does like advertising for apps. Um, so I haven't really gotten my mind into that one yet. It's gone up so much and it's not really undervalued here, so I haven't really looked into it. Apollo Management was on the news recently, um, and they've been going up in price. So I guess that one interesting thing we could do um, was we could look at stocks that have been on our list before and see if they even appreciate. Like at the beginning of this year, we look at our stock screener and see if we have any lessons learned. But we see a lot of financial companies in here. We perhaps they have a lot of catching up to do with the rest of the stock market um, because they are only recently becoming in favor that sector. Um, what other things can we see from this? Um, okay, I found a we're gonna go over Baker Hughes. I'm not sure if we did this before, but I thought it'd be interesting. This is one of the stocks in our screener. Um, it says it says that it's undervalued. Let's look at the PEG ratio according to Yahoo Finance. Baker Hughes, um, its PEG ratio of 0.74, so it's 30% undervalued according to Yahoo Finance. So Yahoo must think that it's growing around 20%. So let's look at the profit margin is 8%. That's like less than our 13% we're looking for. Return on equity is 14%. That's decent. That's really good. And I actually don't have many oil companies in my portfolio. I bought Exxon and Chevron during the pandemic times whenever no one was using oil, and those are the only two I own. So it's only like 2% of my portfolio. So I'm actively looking for, energy stocks for my portfolio. Let's look at see if this has any merits. Um, okay, so we have I looked at the earnings estimates going forward. We have 43% growth from last year to this year. And then from this year to the next year, we're going to have 12%, 15%, and 12%. So if we're growing around 13% or 12% with the PE of 13, the PEG ratio is around 1.1, and that's around 10% overvalued. Um, so the headwinds, things that are bad for the stock, the oil price is really low right now. It's $67. So you're not as profitable. You're not going to make as many sales if there's not a whole lot of servicing for oil. And the oil sector is definitely out of favor. Energy is not performing very well recently. So you can consider this a contrary play. No one wants it right now, and it's steadily growing around 12% a year. So, and if you think about the Trump administration, um, they're going to be favoring um, deregulation for this industry. So that's going to allow there to be more oil to be pumped from America. And this is what this company does. They service oil companies. So if you think of the contrary, maybe this could be a contrary play. I'm going to keep track of this one just to see how it goes. This was actually owned by GE, and GE spun it out. Um, so it's still in the process of getting normalized after a spin out. So let me see. Here's some articles. One is analysis. Strong momentum makes it hard to bet against the freight train U.S. stock rally. Okay, so in the beginning of this talk, let's look at the S&P. You can see that this is what's known as a freight train stock rally. I mean, we have a defined channel. It continues to go up. We have overbought for like 90% of this year. We've been overbought, which is amazing. Only small little downdrafts. Okay, so we have a freight train rally. Momentum is the factor in driving the market. So we have price to earnings ratios, um, 35% above the long-term average. Right now, the market is a freight train and no one really wants to get in its way. Betting against the market with a strong uptrend has been risky. So we have two back-to-back gains of 20% or more since 1928. I don't think we've ever had three. So, um, okay, so the next year, if we've had 20%, two 20% years in a row, the next year average gain is 6.3%, which isn't that great. So, let me see. Momentum begets momentum. So it's we're getting into like a situation similar to March 2000, where the S&P is trading at 5 times the price to book value. That's more than the year 2000. So there could be an overshoot in the first quarter of 2025. So, so he thinks that there's froth in the market, and there's been a rally since the election, and there's of course this speculative fury in the Bitcoin price. These are Bitcoin is the most speculative asset, or whatever you want to call it, in the world. So, the key with all this is you have to make sure that whatever you buy a stock to hold, that it's reasonably priced, such as what I talked about with Bill Nygren. You don't want to pay too much. He's buying stocks with a very low PE ratio for his portfolio, like a PE of 13. That's half of the stock market. And he's holding it for 10 years. So, so right now, you just have to be aware that we're overpriced, we're overbought. At some point in time, trees don't grow to the sky, and we're going to pull back sometime. So Edgar Denny, he's like a very famous economist. He said, sentiment is skewed to the bullish side. There's consumer confidence index and a bunch of other things that he likes to follow. But a near-term pullback would likely get investors to buy in it cheap. So don't be surprised if there's a 5 or 10% correction. That usually happens at least once a year, but we haven't had any 10% correction this year at all. So um, let's look at the next thing. Next article. Investors face a uniquely high amount of uncertainty in 2025. Liz Ann Saunders. Okay, she's the chief investment strategist at Charles Schwab. Um, she said that investors are going to have to get reacclimated to president's more off-the-cuff approach to articulating trade policies. So tweets and short messages and we're going to wake up and we're going to find that there's a new policy. There's going to be there's going to be changes to the way we do business with overseas countries. So he said this has a landscape of uncertainty. We said this the day that Donald Trump was president-elect. We said that there's going to be uncertainty ahead, and be warned. It's going to be just nuts for the next 4 years. So we got to get used to that. And every time that there is something that comes out of his fingers from a tweet, we have to figure out how it affects every company we watch and whether it's going to change our investing thesis. That's not going to be hard. That's not going to be easy. It's going to make things very hard for investing. It was great, I think, during Biden's administration. Nothing happened in, there were very little laws that were passed because of Congress, and there was a lot of certainty because nothing was changing. But now we have a lot of uncertainty. So, in other words, we have to be very conservative. We have to constantly, we can't get too caught up in stocks that are running up in price because trees don't grow to the sky. Okay, that was a good little exercise. Um, okay, so we have another article. The mother of all bubbles in the US is sucking money away from the rest of the world, market expert says. Okay, so we talked about, we had that chart. One, two, okay, there it is. Um, okay, this chart basically shows that the S&P 500 has trounced the rest of the world, um, different major parts of investing for the last 20 years. And um, what's happening is a lot of investing money from around the world is coming into America because we're showing basically the most resilient economy and the biggest promise with some of our AI initiatives. And what's happening is we're we're developing a bubble. So you have to be ready to take some off the table as things appreciate too much. So let's go back to the article here. Okay, here it is. Um, okay, there's a huge sucking sound of foreign capital flooding into the U.S. Okay, so we have the rest of the world may not deal with the faster growth and hotter inflation like we have. We have basically tamed inflation, it seems. We have a good balance of growth and um, and growth for our economy. We have 2.5% growth, which is pretty decent. Um, we've been talking about this guy, Mark Nagel. He runs a fund that does black swan investing. His fund will do 32,000% in a month if there is a crash. But um, a right a broken clock is right twice a day. So he's basically right once every 20 years. But when he is right, his fund's up 32,000%. But you can't go through life worrying about the next correction because these people that predict black swan events are right only 1 out of 32 years or so. And you can't base your investing thesis on that. You have to basically you have to buy and hold and kind of hold through any volatility such as that. So that was a good article. Um, all right. Well, I hope you've been liked that um, presentation, and I hope you have good investing next week. If you have any questions, let me know, and I'll research it. All right. Take care, everybody. I'll see you next time.